Okay.
Let us wait like 30 seconds.
Okay. Maybe while you're doing that, I'll introduce you to some of the things that you can see behind me. If you look just up there, you can see the tip of an umbrella coming down. This was Kalecki's umbrella, which was a present from his wife's parents to Kalecki. I think that they were when the Kaleckis got married. My impression was that he was perhaps not so well regarded because he didn't have a reliable job. He hadn't finished his studies and various other things. And this was a way in which but nevertheless, they wanted to welcome him. And of course, around this, shortly afterwards, he got his big break. He got the job in the Warsaw Institute. So that's that's one souvenir, and then the other souvenir behind my head, you can see the bookcases that and some of the books, although it's difficult to make them out, of the great Polish historian Isaac Deutscher, who famously wrote biographies of Stalin and Trotsky. And I didn't know him. My wife and I didn't know him, but because he died, I think when I was still at school. But we were very close to his widow, Tamara Deutscher, and he who kept Isaac Deutscher's studio, his study, and their house very much as they had it when Isaac was alive, and they and as I remember, it was a typical Central European intellectual's house. The furniture was rubbish. It really was cheap plastic, but the bookcases were beautiful. And going there, I always envied them their bookcases, and for various ways, I ended up. We ended up buying them from the estate after their son died, not so long ago. So this is a sort of, to some extent, a kind of intellectual background. I walk around under Kalecki's umbrella among the books of Isaac Deutscher, and that tells you my my intellectual approach.
Perfect. I mean, I think that the very name of Jan Toporowski makes any introduction of him redundant, I would say. And he also has just introduced himself actually through this memorabilia. But anyway, let me greet all of you here in Moscow, virtually, of course. Winter is coming. As we are here in Moscow, it is -3 already, and we are expecting snow next week. Yet we are gathered now, today, to continue our lectures in monetary history and monetary theory and monetary policy. And just few words. We, as organizers, we did not pursue any particular approach. We did not want to promote any theory or no concept or doctrine of economic policy. But we see that in the modern world, as we used to say, which will never be the same, the interest to monetary policy, to monetary issues is on the rise. And there are many discussions, many debates, many theories, many ideas. But on the other hand, as it already happened many times, not all the new or the modern theories are that new, are that modern. In fact, each time when there is a trouble in global economy, there is also rising interest to monetary issues as well. And as we have seen, the problem here is that particularly in this field, in the field of monetary policies, the divide between normative prescriptions as they are studied in textbooks and between actual policies, this divide is great in the monetary field as perhaps never, as perhaps in no other field of economic policy. So what we wanted to do, we want to provide different perspectives, different approaches in order to make the debates, the problems, the issues raised in the modern days, nowadays, are more recognizable, more comprehensible. That is why we need a theoretical background. That is why we have now with us Jan Toporowski, who is one of the leading authorities on the issue. We will have 4 lectures. Professor Toporowski is professor of London University, SOAS. And I mean, I needn't introduce him. For example, Kaletsky, that's not only an umbrella. I think the intellectual biography of Kaletsky, written and published in recent years by Professor Toporowski, is the biography of Kaletsky, and it will remain so. And it will remain so. So we have 4 lectures of Professor Toporowski, and I believe that after these lectures, we will get a better grasp of theoretical background, theoretical context of modern debates on monetary theory and monetary policy. Thank you very much, Professor Toporowski. The floor is yours.
Okay, well, thank you very much. I'll now I'll move on to my first slides, which I think I hope you can all see. I'll just take this down. That's it. So I can now see what I'm talking about. Let me just say that the let me just add to the words that Professor Melnik has just given us, that I think this is a particularly appropriate time in which to reconsider monetary theory and interest rate policy, because unlike many other branches of economics, the monetary theory does not progress by through making new discoveries which are then verified, or new theories which are then verified with the data, and so we converge on some understanding of reality. Monetary theory makes progress through failure, in the sense of failure of monetary policy. And when monetary policy fails, this is the pretext for the reconsideration and the new theory. Now we are at a time when monetary policy has failed. It failed twice. Once after the 2000 or during the 2008 crisis, and now during the COVID crisis, when it's become clear that the predicted relationship between monetary policy and economic activity is not coming about. And I will be talking about this more in my second lecture today, but what is missing, what is lacking, is an economic theory to explain precisely why. And this is why it is a good time to reconsider monetary theory from all periods, bearing in mind that no monetary theory has ever succeeded, or no monetary policy has ever succeeded as this famous saying goes about politicians, all political careers end in failure. All monetary policy also ends in failure, and that failure then gives rise to the reconsideration that we now do. So let me just give a brief summary of the first lecture that I will give today. This is, I'll discuss the conduct of monetary policy, how monetary policy has been conducted in recent times, and how, secondly, I'll introduce the idea of financial complexity and how this affects the rate of interest, the way in which the rate of interest operates or impacts upon the financial system and through the financial system on the economy. Then thirdly, I'll put forward a new view, which is the idea that under the present ruling doctrine of inflation targeting, we have a situation of the endogeneity of monetary policy. And I will explain what I mean by endogeneity. I don't mean endogeneity of the money supply, I mean of monetary policy. And then I'll give a brief conclusion, and a conclusion that I think will unite what I'm going to say today in my two lectures today and what I will say tomorrow and on Friday. So let me start off the conduct of monetary policy. The conduct of monetary policy is nowadays done by committees. It's done by committees within central banks. It is famously what I would call pragmatic, in the sense that it's based on the latest available economic data. In other words, the data showing the state of the economy as close as possible to the decision-making, or as recent as possible to the decision-making on monetary policy. And then there is this famous term, the monetary transmission mechanism, the mechanism that is supposed to link monetary policy to the actual effects that monetary policy is supposed to have on the economy. That monetary transmission mechanism is measured by the lag between the change in monetary policy and the desired statistical outcome. So that this is supposed to be a technical phenomenon in Britain. This is this lag is something like a year and a half to 2 years. Differs in different countries because of the different structures of the economy. But within this, there is what I would call a situational logic of monetary policy. Central banks operate nowadays in accordance with a certain mandate. And therefore, when the monetary policy committees of central banks make decisions on monetary policy, this has to be justified by reference to the targets that the government gives the bank. In this sense, the central banks are not independent, even the ones that claim to have considerable independence. For example, the European Central Bank or the Bank of England, this is, or the Federal Reserve, they are supposed to achieve certain targets of economic activity, and this is, and they will therefore justify their monetary policy by reference to those targets. This is what the Austrian philosopher Karl Popper referred to as the situational logic. That defines the reasoning that central banks will use. However, this occurs within a situation of financial complexity. And this financial complexity then affects how the rate of interest behaves. Financial complexity arises because there is any given economic activity that requires finance can be financed in more than one way. For example, a firm with its own financial resources can decide whether to finance its let's say a new investment, a new project. It can decide whether it's going to finance this using up its own resources, in which case its liquidity will be reduced, or it can borrow money short term from a bank, in which case this is relatively simple, or it can decide that it can raise long-term finance by issuing bonds or shares. This is a more complex way. Each of these have their advantages and their disadvantages. And some of these are, or the relationship between these different methods of financing can be summarized by the yield curve. The yield curve, this is the curve that shows the relationship of long-term interest rates to short-term interest rates. If you're unfamiliar with the term, you can simply Google the yield curve, and you can usually find the yield curve for, let's say, US government bonds. Actually, I will show you the a yield curve later on in the lecture. The yield curve shows the rate of interest that must be paid on borrowing or that is obtained from lending at different maturities, from short-term or overnight lending to long-term, up to maybe 30 years or longer. It's usually upward sloping. You don't pay the same rate of interest for long-term borrowing as for short-term borrowing. And in this view, the rate of interest becomes something more than just the price of money, as we are all taught in the textbooks. It becomes the rate of exchange or the rate of substitution of one type of financing for another type of financing. So this is one element of complexity, that there is, in fact, the Joan Robinson famously put forward, there is not just one rate of interest. There are different rates of interest according to the term of the loan. And there's another element of complexity which arises in modern economies or in financially advanced economies, and this arises as a result of monetary policy activism. If monetary policy is used actively to try and manage what is happening in the economy, you find that the rates of interest, the central bank rates of interest, are changed more frequently. And what operators in the financial system start to do is they enter into contracts to protect themselves against these kinds of changes by using interest rate and exchange rate futures to hedge these changes. Now I'll be coming back to the significance of this kind of hedging for the operations of the rate of interest. Let me say something now about foreign exchange swaps. This is a new phenomenon. It really emerged during the 1990s. It has come, in my view, to have a dominant role within within monetary systems, and to a very great extent explains why monetary policy is not effective or is no longer effective. One of the problems with studying foreign exchange swaps is that the data on this is very unreliable. These are swaps of bank deposits in different currencies, and they're done between commercial banks. The standard source on this is a survey that is done every 3 years by the Bank for International Settlements. And as you can see, they started these surveys back in the mid-1990s. We don't know what was happening before then, but certainly since then, their number has grown, it's grown considerably. If you take to 2001 as well, they've quadrupled in recent years. But this I should say, this is the number of swaps. Here is the value of the swaps, and it really is phenomenal. If you look at the euro swaps with the euro, between the dollar and the euro, these have gone up from around. These have doubled. No, they've quadrupled since the euro was introduced in 2004, 2003. And 2002, I think, and then considerably, all the others have gone up, but in the case of the euro, the growth has been spectacular. There has been a similar kind of growth, upward growth, maybe not quite as spectacular in the case of the Japanese yen. And then the third currency is the pound sterling, because London is really nowadays an outpost of the American financial system. Now, what is this foreign exchange swap, and what is to interest rates and the money supply, and what central banks are doing? Okay, the foreign exchange swap is simply an agreement between two banks, let's say a US bank, it borrows in US dollars against the security of an investment grade security, a US government bond or corporate bonds with appropriate guarantees. And these dollars are then swapped with a Japanese bank for the equivalent in yen. And this is hedged by a repurchase agreement to buy back the yen or reverse the swap in 3 months' time at the same exchange rate. This is an important thing. Now, what this does is it provides absolutely secure method of borrowing money and creating this both dollar and Japanese yen deposits with the exchange rate guaranteed. For many academics, this is an aspect of shadow banking. If you look at the bank handbook on foreign exchange swaps, it gives you an official view that derivatives are useful for risk management. They can reduce costs, enhance returns, and allow investors to manage risks with greater certainty and precision. An issuer may find it difficult or impossible on account of legal or other restrictions to issue in a particular currency. However, it may be important for hedging purposes or for asset or liability management of the company to have its liability in that currency. And this particularly affects international banks that have parts of their balance sheet in foreign currency. So they may have hold dollar bonds against which really should be hedged with dollar deposits. And then let's say other currency, Japanese yen, assets which should be hedged with Japanese yen deposits. Why is this important? Well, because if you don't have this kind of balanced hedging, any change in the exchange rate or even a change in interest rates will cause fluctuations in the net value of the balance sheet. So the bank may choose to borrow in another currency and swap the proceeds. And this allows the borrower to raise the necessary funds and have the net liability in the chosen currency. Investors may use swaps to obtain arbitrage returns, and there are a small number of investors who do this, and even central banks use swaps for arbitrage returns. I came across a reference to the Reserve Bank of Australia, which is building up reserves in yen and swapping them into dollars. Why? Because they could get higher returns in US dollars. Very often these are done through the Bank for International Settlements, where deposits are made in a particular currency, and these can then be swapped into other currencies. Now, this sounds like a financial derivative, but in fact, this is it can also operate to substitute for the money market. What is the money market? Well, the money markets are the markets for unhedged borrowing between banks to regulate the liquidity of commercial banks. This is the famous interbank market that we find in all the monetary theory textbooks or the textbooks on banking, and the famous discussion of bank liquidity and maturity transformation, which says that if a bank runs out of reserves, it can borrow reserves, it can go into the interbank market and borrow reserves from another bank through the interbank market. But that interbank market is an unhedged market. This is the market in which the banks have you lend money to each other on the basis of the good reputation, the reputation very often guaranteed by a broker of the bank that's borrowing. This kind of risk doesn't apply in the swaps market, because foreign exchange swaps are hedged on another currency, swapping a bank deposit in, let's say, one currency, let's say dollars, for a bank deposit in another currency, let's say yen, Japanese yen or euros, with a commitment to reverse at some future date. And that commitment to reverse is the guarantee, the hedge that makes this a hedged transaction rather than unhedged borrowing. And it was my colleague and friend Fotis Lysandrou, who when he started looking at this particular subject, he discovered that if you go into a commercial bank today, you find that the currency swap, foreign exchange swap dealers are not sitting in the dealing room where arbitrage trades are taking place. They sit in a separate section, which is the money market desk. What's the function of the money market desk? The function of the money market desk is to ensure the liquidity of the balance sheet of the bank. As I mentioned a few minutes ago, a bank has to have if it's going to maintain a stable balance sheet, it has to have assets in one currency hedged with liabilities in the same currency. And this day-to-day hedging is done through these currency swap traders. So they're not looking for arbitrage profits, they're looking for liquidity management, and they're very often willing to pay for liquidity management. Now, why has the system for regulating liquidity transferred from the foreign exchange and arbitrage desk from the dealing room to the room desk? The reason is the Basel Agreement, principally the Basel Agreement. The Basel Agreement penalizes banks for holding risky assets. And if a bank wants to make its borrowing risk-free, it does its borrowing, it does its money market operations through the foreign exchange swaps market and not through the interbank market, because the interbank market is expensive. So foreign exchange swaps and currency swaps, they offer cheaper borrowing than the interbank market. The fee is the margin between the dollar and yen interest rates. That's all you pay. The borrowing is risk-free. It's hedged with good security and a repurchase agreement, and therefore does not require capital backing. And this is what accounts for the decline of the interbank market. If you talk to people operating in banks, they will tell you that the interbank market has not declined, it's migrated. It migrated even before 2008 to the foreign exchange swaps market. And this is due to the regulation of unhedged borrowing, financial instability, and these cheaper foreign currency swaps. And what's happened to the money market since 2008 is that it has become absorbed onto the balance sheet of the central bank. If you look at what is happening on the money market in the US, in the UK, and in Europe, you find that it's mostly the operations of the central bank. The central bank acts as the counterparty in most cases. There are central bank currency swaps, which are arranged by the Fed to assure dollar supplies through the European Central Bank, the Bank of England, Bank of Japan, Banco de Mexico, Bank of Korea. So there are, the Fed assures the liquidity of this market, and the central bank swaps, in fact, resumed more recently in the COVID crisis from March. In fact, over the first 3 months of the COVID crisis, a huge amount, 447 billion, had been swapped between central banks, compared to 583 billion at the height of the American financial crisis in December 2008. So these are the central banks operating swaps of reserves in order to support the foreign exchange swaps market. Now, if commercial banks borrow from the central bank, what they do is you have this standard diagram where I show M. There it shows the supply of money. The rate of interest is supposed to be determined by the quantity of money, by liquidity preference. The supply of money is determined, is shown as M. It's supposed to be determined by the central bank. The demand for money, demand for reserves, is supposed to be determined by so-called liquidity preference, L. What I'm arguing is that this doesn't apply anymore. Why? Because commercial banks can generate their own liquid reserves through the foreign exchange swaps market. So this has been replaced by foreign exchange swaps. What happens is that the short-term rate of interest as the price of liquidity, this is what's dinned into us. If you're a Keynesian, it's dinned into you that the rate of interest is the price of liquidity. It's been replaced by the margin over dollar interest rates, because that is what, in effect, a European bank will have to pay for its dollar swap. What you find is that the initial stage of the monetary transmission mechanism, this initial stage which is widely believed since 2008 to have been broken because the central bank's rate of interest is no longer seems to hold in the interbank market. This has been removed by institutional innovation, it's institutional innovation that is the cause of this shift. And this leads me on to the main point of my lecture, for this lecture. And that is the idea of the endogeneity of monetary policy. A pragmatic monetary policy ties interest rates to the current economic conjuncture. I love the word conjuncture. It's in most other languages have it. The English language has it, but doesn't. But English-speaking economists don't use it. Conjunctura is just simply a good word. The conjuncture, the situation in the markets. What you find is that if you have monetary policy activism, whether it's hedged or unhedged, it means that interest rate changes are discounted in long-term contracts. Okay. The famous changes in interest rates that central banks are supposed to be doing in order to keep inflation on target or to regulate the business cycle, as I will be talking about later. Those shifts don't have any effect on the economic decisions of public. And by the public, I mean households and firms, let alone the government. I mean, they never had much effect on government's economic decision making, but certainly households and firms don't take any notice of interest rate changes. Why not? Well, if you, let's say, take the two of the most indebted countries in the world, if you take households in the United States, households in the United States typically borrow at fixed rates of interest. So changes in the central bank rate of interest, unless they're downward changes, don't cause any changes in the borrowing contracts. If you take in the UK, if you are, and the biggest element of household borrowing is borrowing in order to buy an apartment or a house. No one really takes much notice of the rate of interest, because this is, you borrow for a contract of 25 years at floating rates of interest, and that interest may go up or down. If it's very high today, but it might be lower tomorrow, we just don't know. In fact, the standard way in which people make this decision is by seeing whether they can afford that payment and not how it will, how the rate of interest will change. So what interest rate changes do is they simply alter the rate of exchange between different types of financing. In other words, if you have a choice of different types of financing, the rate of interest, a change in the central bank's rate of interest may cause you to reconsider your financing, but it will not cause you to change what it is that you are financing. So if monetary policy is determined by the current data or data that is predicted from the current data, in data on the real economy, then what it does is the rate of interest affects only the composition of the financial system, but not the real economy. In other words, monetary policy has become endogenous. Monetary policy has become the transmission mechanism from the real economy to financing structures, and not the transmission mechanism from monetary policy to the real economy. And there's a quotation which summarizes this very neatly from an obscure Italian, a third-rate Italian novelist. Actually, I say he was Italian. He wrote in English. He lived in Oxford, and he wrote a novel. His most famous novel is a novel that says, "Don't point that thing at me." It's a novel in which the main character is a rather unpleasant person who is devious and manipulative and thinks that he's manipulating everyone. And towards the end of the novel, he's disillusioned, realizing that all his manipulations and intrigues have failed. And he says, the events which I thought I was controlling were in fact controlling me. And this, I would suggest, is the situation that central banks find themselves in today, that they think that they are controlling events. Their main claim is that they are controlling events, but in fact the events are controlling the central banks, because it's the events that make the central banks do what they are doing, and there is no influence from what the central bank does to what is happening in the real economy. So let me come now. Let me pull all these threads together. The consideration about the rate of interest and the way in which its function has changed with the institutional innovation of swaps, of exchange rate and interest rate futures, of the discounting of monetary policy activism by people who are making economic decisions. And I want to put this in the grand context of the history of ideas about the rate of interest. And I want to argue that what's happened is that we've moved from the classical theory of interest. What do I mean by the classical theory of interest? What I mean by that is precisely what David Ricardo meant by it, where he said that the rate of interest is not regulated by the abundance or scarcity of money. If I can just go back, to this. David Ricardo was denying this idea that the money supply can at all affect the rate of interest. But instead, it's regulated by the abundance or scarcity of that part of capital not consisting of money. So what David Ricardo meant was it's that part of the capital of the country, the non-monetary capital of the country, the productive capital of the country, which in Ricardo's view determines its productivity. So you have here the elements of this idea of the marginal productivity of capital, of real capital, productive capital, determines the rate of interest. And we go from this through Wicksell, early Keynes, Irving Fisher, the monetary business cycle, through even the new neoclassical synthesis. All of them have in common this doctrine that economic activity is arbitrage between the rate of profit, what Wicksell called a real or a natural rate of interest, and the money rate of interest. Wicksell famously argued that the business cycle was determined by whether this real or natural rate of interest or the rate of profit was higher or lower than the money rate of interest. Through Keynes and Kalecki, Keynes, who in the general theory famously put forward a purely monetary theory of the rate of interest. And what Keynes meant by this was that it was a theory of interest that was unrelated to the rate of profit on real activity, in which the rate of interest is regulated by the abundance or scarcity of money, to what I would put forward for your consideration as a purely financial theory of interest, a theory of the rate of interest in which that interest reflects the liquidity and the rate of exchange between different types of financing. And obviously, I think there are people who know the work of Keynes possibly better than I do, undoubtedly better than I do, who will say that there are elements of Keynes in this. I think this goes beyond Keynes. It's a view that the financial effects of the rate of interest are everything. And actually, the monetary effects, the effects of interest as an own rate of interest on money, as Keynes had it, is insignificant. It's what changes in the rate of interest do is they change financing, the advantages or the convenience of different financing options. And I'll be talking about that later on later on today. But I would argue that the reason why the financial markets observe so closely what central banks are doing when they decide on monetary policy. The reason why they observe monetary policy so carefully is because they know that any change is going to affect financing options or the advantages and disadvantages of different financing options, and they need to stand ready with those financing options. But that is an issue for the financial markets. It's not really an issue for monetary, it's not really an issue for the real economy, not even necessarily an issue for inflation. So even if monetary policy is endogenous and has no effects on the real economy, monetary policy can still affect financial stability and asset prices. And we've seen how this has worked very, very effectively since 2008 with quantitative easing and open market operations, currency swaps and so on since 2008. Asset prices have gone up substantially in Europe and in America, where there's been the biggest quantitative easing. Actually, in Japan, especially, Japan pioneered all these measures, but they found, but in many respects, Japan is a prototype of the benefits and disadvantages. It's a prototype of what I've been arguing, that it actually hasn't affected the real economy much in Japan, but it has certainly changed the financing structures of Japanese corporations. So I will finish off there. Let me complete my my lecture. This is the end of my lecture. I will be expanding on some of these topics later today and tomorrow and on Friday. But yes, do you want to? Does anyone have any questions? You know, if you do them through the, someone want to do them through the chat function. Have you been doing them through the chat function, or have they been direct?
I mean, we can. I think Evgenia was the first. Please.
Okay. Okay.
Good evening. Thank you for interesting lecture. And can you hear me?
Yes, we can.
Yes.
I have question. on the lecture, do I correctly understand that the interest rate channel now is not as effective as it was in the past, and due to foreign exchange swaps? And if it is so, how changed the role of central banks today in achieving stable inflation?
Yeah.
Thank you.
Okay.
Shall I take all three questions?
I think it's better if you ask, if you answer now, then we'll collect other questions.
So we'll take all three now.
No.
Yeah, okay. Yes, yes, I'm arguing that the interest rate channel does not work. In fact, if you look at the recent publications by the Bank of Japan, or maybe, well, this was before Shinzo Abe, Premier Shinzo Abe resigned, but the Bank of Japan was actually arguing that in any case, the interest rate channel really operates through the long-term rate of interest, which is a very, very Keynesian view. And in fact, one which I will be discussing later today. But it still turns out not to have been very, very effective. But again, it depends on what's meant by effective. In Japan, if you have slow growth, this is considered to be effective. But certainly in terms of inflation, there's been very little impact on Japanese inflation. I believe that the recent inflations are largely arise out of the situation in the labor market in different countries, rather than any monetary source. Okay.
Thank you. Can I just add to the one question again about, according to your lecture, it means that the Fed Reserve's policy now is not right, because in the USA you can see that Jerome Powell, for example, were concerned about unemployment rate, and the Fed Reserve thinks that the rise in interest rate can affect the employment rate. So, but according to your lecture, monetary policy can't affect real economy. So the question, do you think that the policy, stimulating monetary policy, can't really stimulate the employment rate?
Yeah, well, I would just say about the situation in America. The situation in America is unusual because the Federal Reserve has a mandate which covers not only inflation but also a high level of employment. So what Jerome Powell is doing is he's responding to the situational logic in which the Federal Reserve finds itself. It believes that it has to take action, so it takes some action. What I would say is that there is a very peculiar situation in the American labor market, a peculiar situation caused by the COVID pandemic. This is a similar situation here in Europe, and I guess also in Russia. And it's this situation in the labor market that is affecting the rate of inflation, and not anything that the central bank is doing.
Thank you.
Okay, thank you. Next question comes from Davud. Please.
Okay. Hello. Dzień dobry, panie profesorze. Yeah, it's really an honor for me to have a lecture with you. It is although I've been hearing your name, especially here in Poland, Warsaw. Thank you very much for great lecture, Professor, because that idea, the concept of interest rate has been a goal of my research. I depart from I hold rather monotheistic views on this interest rate, which is, in fact, there shouldn't be interest rate, Old Testament, New Testament, Quran. Though, I'm open-minded and try to empirically understand the interest rate idea. And I should say that your understanding of endogenous monetary policy is something novel, or perhaps I haven't heard, because there's this popular understanding of endogenous monetary policy, which says that effective demand for loans, due to the effective demand for loans, money is created. But your suggestion is categorically different. Well, at least for me, I might be mistaken. And so the question is, Professor, because what you imply is that central bank fine-tunes the interest because of those international currency swaps and other derivatives. And so all these myriad of exchanges, do they not presuppose the very initial interest rate upon which all other interest rates are shaped? It's like say, sixth car is pulling seventh car, fifth car, sixth car, and finally there should be one locomotive. That is the question. I hope I made myself clear.
Yes, you're right in the sense that we now live in a world that effectively operates as a currency zone of the United States, and the alternative to it, which was supposed to be in Europe, is gradually becoming dollarized, as my friend John Grahl has recently argued. And therefore the dollar rate of interest acts as a certain benchmark. But I'm not sure that how far one can go with this idea of a benchmark, because it's certainly not the case that other central banks will operate or will change their margins in relation to the US dollar. Will change their interest rates if the United States changes its interest rate. They will tend to operate in accordance with domestic priorities. So I'm not sure that there may be a benchmark, but the margins are not something that is objective.
Okay, thank you.
Thank you. We have 3 more questions. May I ask be concise? Ilhan, please.
Hi, I hope you can hear me.
Yes.
Hi.
Yes, I can.
Yeah, hi, Yana. I hope you are doing well.
Thank you.
What you told reminded me about what Kaldor once said, if I'm not mistaken. He said, except geography and history, everything is endogenous. Based on that, I would like to highlight the endogeneity of monetary policy does not make the interest rates endogenous. I say that because once I discussed with Turkish former vice governor of the Turkish Central Bank about the exogeneity of the interest rates, he said central banks considers the current economic development and they have a reaction function. That's why interest rate is endogenous. But I guess this is not what you are arguing, right? Could you make it clear whether what you mean regarding the endogeneity of monetary policy and distinction regarding the exogeneity of interest rates, which means that interest rates are not determined by the supply and demand for credit. Yeah, thank you.
Yes, thank you, Ilhan. Actually, yes, it's a very useful question, because I want to make clear that this is a view that emerges out of a consideration of the ruling policy doctrine since the 1990s, which has been one of inflation targeting. In other words, that the central bank operates its monetary policy in order to regulate the rate of inflation, and it's that I want to challenge. The situation of developing countries and emerging markets. Now, possibly in this context, Turkey is, you could say, is more of an emerging market. I would say it's different, and I think more complex. And I hesitate to say any more, because. But what I would say is that yes, it's certainly the economic development prospects of a given country are important in this context, but perhaps even more important is the economic structure. And if you have an economic structure as you have in Turkey, dominated by conglomerates or by companies organized in holding companies, with effectively a treasury function that acts as an internal bank, then the function of this is actually the effective function of this is to isolate the economic activity of a group of companies from monetary policy. So this adds to the ineffectiveness of monetary policy. Sorry, I would like to. I'm still thinking this through, and I would like to discuss this with you one day.